U.S. financial history. We have the lowest interest rate on long-term government bonds in the history of the United States. That goes back to 1790. 229 years, we have the lowest interest rate. So to get your mind wrapped around this, you got to understand what's happening. The first basic to understand is that we're talking about fixed income bonds, and it's a contract, and it has a nuance that are not readily understood. Basically, a low interest rate is a reflection of very high prices being paid, extreme demand for U.S. Treasuries, high prices. Now, why does it translate to a low yield? Well, basically, the contract states the number of dollars the owner receives at a future point in time, called the principal, and the contract also states in fixed dollars the number of dollars of interest that will be paid periodically until the bond terminates. So basically, what happens is these bonds are sold in a secondary market, and every day the price changes, and the more enthusiasm for bonds, the higher the price. And ironically, the flip side of paying more for the same number of dollars coming out of it, basically the implied yield declines. So the enthusiasm of buyers translates into lower yield, which is unusual. I mean, most people would think we're having a lot of net selling, but we're having net buying. Huge demand for long-term U.S. Treasuries. So where is the demand coming from? To create the highest relative price to the fixed income payments in our history. It's coming from a place not that what we accustomed to thinking of a source of capital to be buying treasuries. And let me explain where it's coming from. Now, the usual way, let me go through the usual sources of extreme buying power. The usual first one would be U.S. investors, dollar investors looking for a safe asset during economic distress times. Basically, if you go into a deep depression or deep recession or depression, the market veers away from equity type returns because companies are not selling product in a depression and profit is down. So they shift their portfolios, the weight of their portfolios, to safer fixed income assets, and the safest of all is the U.S. Treasury, more so than corporations issuing bonds. So the usual time the demand is extremely strong is a depression, and it comes from private investors shifting their preference of assets they wish to hold in that particular environment. Now, the other thing that occurs that stirs demand for treasuries is if we have deflation, because the nature of a bond is it is a fixed dollar payoff. And if you have a deflationary environment, that means the prices of goods in the market are declining. So a fixed dollar payment in a deflationary period of time is worth more because its command over goods and services in the goods market increases. So you put it together, a depression and deflation. That combination, which is a tough combination, happened most in the 1930s in the Great Depression in the United States and actually worldwide. And as you would expect, the demand for the treasuries was the greatest, the price paid was the highest, the yield to whoever paid a high price was low, but it was still positive. It was the lowest the 30-year treasury yield got to in the middle of the Great Depression, which was our previous low, was 3%. Now, here we are in 2019, and the yields are lower. So what in the world is going on? Where is the demand for the U.S. Treasuries coming from? Well, it's not from the private market where they're running from a deflationary depression. If anything, our economy, while still growing, it might be growing a little slower than last year, but it is growing. And how about deflation? Well, we have some inflation between 1% and 2%. So the model does not fit the previous circumstances where the private market ran to load their boat, so to speak, with long-term treasuries. So where is it coming from? Well, the next usual place that people have been trained to look is the central bank. because in the 1930s, the Keynesian economics revolution put out the notion that to try to save us from a deflationary depression, it would be very helpful if the central bank went on a buying binge and bought bonds. And how do they buy bonds? Where did they get the purchasing power? They literally print the money and buy the long-term treasuries, which lowers the interest rates in the market. The whole idea in Keynesian logic, which still 70 years later is still being applied, is that the lower the interest rate, more folks would be stimulated to borrow the money and, for example, buy a car or buy a house or buy something. So basically, that logic still prevails, and our central bank still tries to offset an economic downer by low interest rates to create credit, cheap credit, so people borrow, add the debt to their own balance sheet, and buy goods. Keep companies selling product, keeps the demand for jobs up, and basically more or less works. Works a little less than it used to work, but it still does work. Basically, in the past, when foreign central banks went on a money printing binge and buying bonds in their own country's bonds denominated in their own currency, it never overflowed to the U.S. They never ever bought U.S. treasuries. I can't say never, but it would be an extreme, unusual situation. That they didn't conduct monetary policy by buying U.S. treasuries. So the question is, what happened over there? They went to the extremes of trying to get the interest rates as low as possible, and given the conformity to Keynesian ideas, that would stimulate spending, people borrowing and spending, and stimulate the economy and put people back to work in those countries. But basically, the foreign central banks never bought U.S. debt instruments. But then the question is, why did the private parties not buy them? Well, basically, for a long time, we had something called capital outflow restrictions, where countries would have a bias to putting a barrier around the border of their country where their own citizens who save funds would not be able to invest those funds in, let's say, the U.S. stock market or the U.S. bond market. The reason being is they wanted their savings to be directed to financing investments in those countries. So basically, we lived for a long time under capital outflow restrictions. That started to get eliminated with the EU, with the beginning of the European Union in 1990. They eliminated capital outflow restrictions. So basically, private parties could move capital out, investments out of their home currency to the U.S., but they rarely did it. But now we're in a situation where the central banks of Japan and the ECB have not only lowered the yields on their market instruments, not only from a low positive number, they will plunge past zero into a negative yield. A negative yield means the price is so high that the price exceeds all payment of principal and interest over the life of the bond. So basically, they went into uncharted territory, totally uncharted territory, negative interest rates. Well, it turns out that why then is the capital trapped in a country or in a region where the earnings by the investors, and particularly think about the institutional investors who are investing funds for pension funds, endowment funds, insurance companies, etc., they have defined obligations. And here they're forced to buy assets with negative yields. Well, they're not going to make their defined obligations. So basically, for about 4 or 5 years, the pension funds in those countries were forced, giving. Now, by the way, they lowered the capital outflow restrictions at the country level, but each one of these institutional investors still faced restrictions on their own, quote, defined in their own investment mandate. What is it as an investment manager that you can invest in? And virtually all the pension funds, for example, would say you can invest as you see fit given certain minimums and maximums of asset categories, but you can't move money out of our own currency to maybe some extreme small amount, maybe 5% of our portfolio. So they were faced with internal restrictions based on and it's something called a mandate, an investment mandate that managers operate under, which complied with their which were really a reflection of their financial obligations. So, as a pension fund, if you are on the line to providing pension support in your currency in years in the future, you have to earn a yield in your own currency to satisfy that obligation. So basically, investment managers were faced with mandates that trapped the great majority of the funds in their own currency. Well, guess what? After 5 years or so of now receiving not only low interest rates, not only zero interest rates, but negative interest rates, well, they're obviously on the way to defaulting on their obligations. So one by one, investment management went back to the board of directors and said, we're going to have to expand the mandate to allow a greater participation in bonds or in investments in places that have a higher yield than negative.